Hello, everyone. Welcome to today's webinar, Meeting Asset Owners Where They Are, Exploring the Effects of COVID-19. We're really glad that you're able to join us. Just a few house rules before we get started. Your mics will be muted for the duration of the webinar to ensure that we can maximize video and call quality. We will leave ample time for questions and answers, so we encourage you to use the chat function to send us your questions throughout today's discussion. And if you're feeling comfortable, we'd really encourage you to join us over video with turning your camera on. So we will kick off today's session by turning the mic over to our moderator, Rahana Nathu, founder and CEO of Spectrum Impact. Welcome, Rahana.
Hi, good morning, everybody. Thank you so much for being here. We're thrilled to have you. Hopefully everybody can see and hear me. I am the founder and CEO of Spectrum Impact. We are an impact investing strategic advisory firm, and we principally help organizations figure out how to build their impact investing strategies and footprints. It is my incredible pleasure today to introduce you all to episode 2 of a new webinar series that we've created around impact investing. And our goal with the webinar series is basically to bring together best-in-class experts, thinkers, advisors, people with really strong, very smart opinions to talk about the different areas of impact investing, both generally, but also in light of COVID-19 and all of the impact that that's had on the work that we do. So I'm thrilled to be able to introduce to you 4 very, very incredible, quite insightful, equally hilarious human beings that take this work around gauging the perspectives, opinions, and insights of asset owners very, very seriously. So it's my pleasure to introduce Catherine. Catherine is a managing director and financial advisor at RBC Wealth Management in San Francisco. So both Catherine and Justina have agreed to do this on Pacific Standard Time, which is beyond generous. So thank you both. Catherine co-leads a team that focuses 100% on aligning clients' long-term financial goals with their values and mission. And they do this through sustainable investment strategies. So thank you, Catherine. Next, we have Justina. Justina Lai is Chief Impact Officer at Weatherby Asset Management, which is a registered investment advisory with $5.8 billion in assets under management. And Justina leads the firm's impact investing effort, as well as impact integration across a variety of different services, including investment management, client service, and internal operations functions. So she has a really easy job, which we'll get to hear a little bit about today. And last but never least is Eric Stephenson, who is Director of Client Services at Align Impact, a member of its investment committee, and also advances the firm's work in helping investors and their advisors form and implement effective impact investing and philanthropic strategies. And we'll get to learn a little bit about Align's very, very creative approach a little bit today. So we'll kick right off. As Carmel mentioned, we're going to save some time to ask some questions, but most importantly, this is an opportunity for you all to tell us a little bit about what you want to hear. So bring the questions, please pump them into the chat. And right off the bat, for all 3 of you, Justina, Catherine, and Eric, could you share a little bit about how your firm thinks about impact? And Justina, we'll start off with you.
Great, thanks so much, Rahana, and good morning, everyone. Happy to be here. At Weatherby, we use impact investing as an umbrella term to encompass the full spectrum of approaches towards creating impact. So everything from negative screening to ESG integration to thematic investing within environmentally and communities-based themes. We have a process by which we qualify investments as impact, and then have a way of characterizing the impact that investments are creating through an impact classification framework that describes the impact approach, the impact objectives, the impact sectors, and the geographies. And because we build custom portfolios for our clients, we're able to really work closely with clients to develop specific theories of change, and impact investing strategies for each of our individual clients. And from there, we're able to match based on what we've laid out for each investment as its classification and characterization of impact with what we've defined as the impact investing strategy for a specific portfolio.
Wonderful. Thank you so much. Eric, we'll go to you next.
Yeah, thanks, Rahana. I think that at Align Impact, we look at impact as really being fully present when making decisions, right? Not just investment, but consumption, whether it's a cup of coffee or a meal, right? Am I aligned with how this was made and how it affected the people who made it? When picking service providers from car share to construction, am I aligned with how they treat employees? Will my house have use extractive energy or clean energy, right? So we have a holistic approach to impact, but today it's really an honor and really a privilege to speak about it from the perspective of an investor and with these very esteemed co-panelists.
Awesome. So appreciate that. And Catherine, maybe we'll round off with you.
Great, thank you. And thanks for having me today. It's really great. So I'm with RBC Wealth Management, and RBC stands for Royal Bank of Canada, for those of you who may not know on the phone. RBC is a very large global financial institution, but our team specifically in San Francisco is a team of professionals. There's 9 of us, and 100% of what we do is focused on sustainable investing and impact investing. And so with us, everything starts always with the client. It's very much a customized approach, matching their specific values, their specific financial goals, mission, everything together, and figuring out what is the path. We have questionnaires that we use as springboards to do our due diligence and really map out the path, the strategies. And we are consultants that look at the whole spectrum of investments. Anything from the public equity, fixed income side to alternatives, community investing, cash management, operational reserves, the whole shebang. So for us, it's very important to have a very customized to the client approach and specifically what they're trying to get out of their long-term financial goals, melding with impact and sustainability.
Wonderful. Thank you. It strikes me as we're digging into this that all of you talk a little bit about the value of customization, and that values alignment really starts the conversation in many ways. Whether we're talking about the values of individuals or institutions, I'm wondering if you can all speak briefly on some of the impact themes or sectors that you've seen that have really risen in terms of attention, both at the client level, but also just in the work that you do. And we can structure this conversation as pre-COVID, because I know we'll dig in pretty deeply on the impact that COVID has had. But just themes around what asset owners want. And maybe Eric will kick off with you.
Yeah, no, that's so in terms of themes, I'd stay a bit high level. So we work with approximately 45 families today, all of which have certain things that they care deeply about. So we've seen them really break into 3 different types of themes, right? One is staying true to some type of area of experience or expertise. So either a strong experience in some type of sector or theme, or expertise, meaning you worked in tech, so now you do impact investing in technology. Second is really a shift to respond to themes driven by major events, right? So I like to think of that as defining responsibility as the duty to respond with your abilities. And if that's as an investor or a grant maker, then being able to immediately answer the callings of whether it's natural disasters to social justice movements, right? That's how you view kind of your participation in assisting. And then you have clients in between where they stay true to some type of experience or expertise, but they have some type of carve out allowing them to respond to things that are happening today in a way that they feel that they can be helpful.
Yeah, that makes a lot of sense. Eric, maybe a follow-up question, especially around the excellent point that you made about someone's professional background being a part of how they think about values, and you all seeing sort of a connectivity there. Are there particular sectors, you referenced tech, but are there particular sectors where you're finding that, like, oh my goodness, this is all anyone wants to talk about now through that connection?
Not necessarily. I think similar to looking at impact holistically, we really challenge our clients to develop, or at least almost facilitate a conversation to articulate how we feel on multiple impact themes, because you can't look at any one of them in a silo. You have to look at the intersection, right? So if you're focused on, some more supporting female-led entrepreneurs, you can't look at that in a silo with climate change or even social justice movements. So I think that you have to look at the intersectionality rather than saying, hey, this is all we want to talk about day in and day out. So we haven't had experience in that.
Well, that's great to hear that all of those themes come together, and I know we'll dig into that. So I appreciate that. Catherine, what about you? What about for RBC?
Yeah. So as I mentioned before, we are very much customized consulting group. But if I were to characterize some of the major areas that the clients have really gravitated towards, certainly climate change, environmental sustainability has been a big focus of many of our clients. I don't think I mentioned this in the beginning, but many of our clients are institutions. We work with a lot of foundations, we work with a lot of nonprofits in terms of values alignment. And actually, of the original Divest Invest Philanthropy Group, the original 17, many of them were actually clients of ours. So a lot of our clients are very much on the cutting edge in terms of making sure their philanthropy is really leading. And certainly in the environment, climate change issues, renewables has been a very strong focus, which we've been able to integrate across the portfolio. But, in addition to that, another area, and this is pre-COVID and pre-George Floyd too, a lot of issues around racial equity, gender equity. And that, I would say, certainly over the last 5 years has been, every year increasingly very, very strong interest from clients in terms of, well, how do you really integrate racial equity? It's, very different approach from, how you might do so with environmental sustainability, looking at managers, obviously, racial composition and gender equity, a lot of shareholder action as well. You see a lot of that with the gender equity pay issues going along. So those have been very strong themes over the last few years. And certainly community investments. We've seen, a real big push towards local investing, community, and those, I would say those three areas have been really, strong focus points for our clients over the last few years.
Yeah, that makes a lot of sense, and it's very temporal. Maybe a follow-up question there, Catherine. You pointed to a lot of interest on the environmental side, and then some thematic areas that would fall under the S, like racial equity or gender equity, or even community development or place-based investing. When you think about client interests, do you find that some aspects of that are more formed when clients come to you, or is that entire process, regardless of whether it's E, S, or G, is that cultivated together? I mean, what is the level of sophistication that you're finding as people approach RBC?
Yeah, that's a really interesting question. And we've noticed certainly a progression. So 20 years ago, when we were, seeing clients and they were thinking about this, I think there was a lot more, well, what does this really mean? What is socially responsible investing? Then they had to learn a new term. What is ESG? And then what is impact? And, I think our industry certainly could have, done a little bit better job in terms of the nomenclature. But I would say that previously, I think it was a little bit more like, gosh, what does this all mean? Can you help me map through it? And, as we've seen again in evolution, what we've noticed is, people have certain issue areas and, they'll come to us and say, yeah, I really want to do this, but I really want to focus on climate change and, women's issues. But it doesn't mean that other aspects of the value proposition aren't there. It's just that they may have just really been percolating with these ideas more recently, certainly much more in the press. And so they might have gotten more of an inkling. So there is a little bit more of a sophistication with clients that we've noticed, certainly over a 20-year journey.
Yeah, which is a great thing to hear. So thank you. Justina, what about you? Trends, particular trends that you're noticing?
Yeah, I would say that a lot of my comments would probably echo what Eric and Catherine have already said, but I want to underscore something that Eric said around intersectionality. We really, similarly believe that a lot of these issue areas are inextricably linked. And so if you care about one issue, you really need to think about the effects and impacts from another area. So, I know we're talking about pre-pandemic right now, but if you think about the disproportionate impact on communities of color from the pandemic, we know some of that is related to the social determinants of health, but also we know that it's partly because Black and Brown communities tend to live downstream from power plants and have much higher levels of pollution and exposure to toxic byproducts, and that, so climate justice is inextricably linked with that of social justice and racial equity and gender equity. So all of those things are interlinked. The other thing I would mention is we do have clients that come with very specific ideas of what they want to address, but it's also partly our job to set expectations appropriately about the role an investment portfolio can play in addressing social and environmental challenges. Investment capital can't solve all problems in the world. I want to be clear about that. This is not a silver bullet. So for us, it's really an exercise in resource allocation. We recognize that other forms of capital, like philanthropic capital and human capital and social capital, might be more scarce and therefore have a much higher opportunity cost. So where possible, we want to use investment capital to address particular challenges so that the more scarce forms of capital can be preserved to be used where it's most needed and most impactful. So really it's about resource allocation and where these kinds of concepts can serve to reduce risk and enhance return within an investment portfolio while addressing social and environmental challenges.
Yeah, wonderful. All three of you sort of spoke a little bit to you said it so articulately, but all three of you spoke a little bit to the fact that while the context of our conversation so far has been pre-COVID, a lot of, at least what Spectrum has found in our work is that some of the issues that asset owners are really interested in are the areas that COVID has simply shone a light on. So clearly there are systemic failures. There are things that need to change. These failures are not pandemic right-sized. They were there before the pandemic, but just the pressure on socioeconomic factors have made it clear that there is an urgency that was kind of, I think, distracted in the conversation before. Climate is certainly one. Racial and gender equity is certainly one. Community-based investing is certainly one. I think one of the things that we often forget is that COVID-19 specifically has impacted almost every industry, and investments are certainly no exception. And the three of your organizations have the added, I think pressure is the right word, of having to then translate what's happening in the world into responding to clients. And then on top of all of that, doing it in an increasingly virtual way. So it's not an easy time to be in the space that you guys are in. All of that being said, we've heard a lot of really great insights about positive client pivots, motivations, and reactions. And I was wondering if you all could weigh in a little bit on the behaviors and actions you've seen on the client side, again, whether individual or institution, that in light of COVID-19 have actually surprised you for the better. And maybe Catherine will kick off with you, but Justina and Eric, please feel free to jump in and respond at any point.
Sure. I think in terms of just getting back to how we approach things, we always have a plan. We have a long-term strategic plan, an allocation. We have goals that we're trying to achieve over the long run. And, what we found, I think within our practice for the most part, people were pretty calm and did not react adversely. You always want to make sure you're not doing anything in a market that's just going down real fast. So I think I was pleased to see that. Certainly I heard many stories outside of our practice where people were really caught in a really bad situation. We had been in this huge bull run ever since the last financial crisis. People had gotten complacent. They hadn't realized how risky they actually had become over the years. And I think that's a real danger if people aren't constantly monitoring and doing reviews and evaluating performance. And that's kind of part of our DNA of how we're constantly reviewing portfolios. So luckily our clients were insulated from that, but certainly heard a lot of stories about people reconsidering what risk really means to them, how risky they want to be in a portfolio, really thinking about liquidity, because I think a lot of people, again, outside of our practice, were a little caught in terms of not having enough liquid assets, cash specifically. Certainly you saw that on the institutional side. And I think that just kind of pushed people to rethink, what does risk mean in your portfolio, really getting back to basics, having a plan, having enough liquidity. And I think actually in terms of one of the most pleasant surprises is that we were actually able to close a private equity fund and bring in an allocation of private equity into our clients' investments right in the thick of the huge downturn, which it just really shows that, clients can be very sophisticated and they recognize, hey, look, private equity being long-term capital. This is not a day trading type of exercise. Certainly there could be a lot of value in that, and really sticking to the plan is a really critical element.
Yeah, and it's great to hear. I think sometimes we talk about clients, sometimes the way that we talk about children inadvertently, right? So it's an education and babysitting and hand-holding process, but really, I think just unbelievably comforting to hear, Catherine, that you've actually found that the level of sophistication that RBC tries to impart stays. I mean, it doesn't go away just because of the pandemic, as frightening as that is. Eric, what about for you and for Align?
Yeah, echoing a lot of the comments that Catherine mentioned, most of our clients are strategic investors. So the importance of the plan, right, as equity markets go up, making sure you de-risk it, staying true to certain asset allocation parameters to ultimately achieve certain goals that you have for you, your family, or your charitable goals. So we've seen a lot of revisitation to IPSs, to the plans we put in place, both financial and impact. And I'd say we also have some clients who are tactical investors, right? Who do have means that they likely have more means than they'll need it during their lifetime. So they're able to take a bit more risk, and have really stepped up and said, hey, if I can take on more risk and I have the means, maybe it's my responsibility to deploy capital now, right? To CDFIs, potentially who need it most, who have been in the communities, rather than going out and looking for a new partner. And the last thing I might add there is just, and I see my colleague on the call here, and so at Align we've been talking a lot about what happened with the CARES Act, right? So the CARES Act passed as a response to COVID and had a provision whereby people could offset up to 100% of their income by giving directly to charitable organizations. So this allows advisors to revisit the plan, but also do some great philanthropic and tax planning with clients to help them support charitable organizations that they care about, and maybe they can more efficiently give to today when that need might be greatest. So we've really seen an increased commitment to both philanthropic commitments and PRIs.
Eric, maybe a follow-up there. I think often in impact investing, we talk about capital is quite finite. And so there's this tug of war between philanthropic assets and investment assets. And the idea that it's zero sum, that whatever you take out of one doesn't necessarily go to the other. And one of the things I think that all of your organizations have in common is the idea, and you've all spoken to it, that there is a spectrum of capital, no pun intended, and that there is, yeah, really should have thought that one through. But there is sort of a spectrum of capital, and that you can deploy into these different areas that then sort of raise the leverage and interest of these other areas. Eric, to your point about the incentive with the CARES Act to actually increase philanthropic allocations, do you find that post the pandemic, people are making those trade-offs? Your clients are making those trade-offs when you talk to them? Or is the conversation, I want to increase the philanthropic allocation, and where appropriate, I will increase my investments? How is the conversation unraveling?
Yeah, spectrum of impact, and you want to align those with your values.
I see.
So, no, it's a great question. And I think that so you have a lot of different levers within your portfolios. And sometimes clients don't really recognize that it's not just philanthropy and it's not just investment. So during the time of COVID, if you wanted to support perhaps a for-profit social enterprise that you invested in, you couldn't necessarily give a grant to them, albeit they may have needed it because revenues may have went to zero. They didn't want to give up more equity in the company. So we had some clients who gave kind of a very low interest, favorable term loan to the social enterprise. And that's a lever that you could use. You could write it as a PRI if you're a foundation, and that could go towards your 5%. If you said, well, we don't know what's going to happen at the end of COVID, our corpus could be down 5 to 10% at the end of the year. Maybe we write this as a PRI today with the expectation, the hope that you get those assets back at a future time. So it's not just the spectrum of assets, it's really understanding what are the levers that you have in your portfolio and which levers or types of capital are most needed by that organization. Because just like us as individuals, every organization is so unique in its needs and its goals. So how do we kind of meet in the middle and figure out how to be most helpful?
Yeah, truer words. Justina, in your role as Chief Impact Officer, which is just about the best, I think, the best title on the planet, you have a really, really critical and important role sitting across, as you said, as we talked about earlier, across multiple functions. And so I would imagine that some natural trend spotting has to occur. I mean, in light of the pandemic, what are some of the other things that you've seen that just have sort of surprised you?
Yeah, I don't know if it's necessarily a surprise. Well, first of all, I was waiting to see how Eric was going to fit weather RBC into that. I was really disappointed. Eric, I want you to spend the next couple of minutes coming up with something because, I feel a little left out. But
You all want to weather the storm. No, I'm sorry. Go ahead.
Close. But, the RBC is going to be the tough one, I think. But back to the topic on hand, I think, I think you've already mentioned it, Rehana, which is, none of this is new necessarily. I think what the pandemic and what, the protests following, the killing of George Floyd have illuminated is the existing structural systemic racism and inequities that exist within our economy already. But it has been, if there are any silver linings out of this, it is that this has now been brought to the forefront of the public consciousness. And I think that, some of the trends that Catherine and Eric mentioned in response to the prior question hold here as well, which is there's a real opportunity to focus on sort of the S and G, while recognizing that the E, again, is inextricably linked and has effects on the S and G. But, in terms of client response, we also saw that, ESG integration helped outperform. ESG integrated funds held up better through the pandemic. And the reason for that is not only sort of the lack of exposure to energy as a sector, but also the focus on the S and the G, which helps companies weather this storm better. If you've got better paid sick leave policies, if you've got better pay equity, if you've got, if you've got better contractor and part-time worker policies, all of those things serve to help you retain your employee base, which is really important in preserving your brand reputation, and as well as helping you, when there is an eventual economic recovery, not having to retrain and rehire workers. So we know all of that is important, not only from the perspective of a moral imperative, but also from the perspective of better long-term financial performance. And so, similar to what Catherine and Eric have mentioned, it's about sticking to the long-term plan. But I think what we've seen out of this is similar to something that happened within the space post the 2008 financial crisis, is to the recognition that actually, impact investments and ESG integrated investments can help provide a stabilizing effect within portfolios. And so, even if you were focused purely on the financial performance, it makes sense to invest in this way.
Yeah. And the fact, I think what you've all spoken to, but Justina, it strikes me in your comments, we really did historically think about the E and the S and the G, the environmental, social, and the governance, as very separate, distinct buckets. And I think what's really coming through for me as the three of you are talking about your work is that this has also been sort of a hidden opportunity to think about how they all work together, and sort of exclusion in isolation is certainly not going to get us anywhere towards our goals. As you always do, I think you've sent us on exactly the right path to dig in a little bit more on some of the issues that at least we're hearing from our client base are very, very topical. And we've all been talking about them over the course of this conversation: climate, gender, racial equity, place. I would love, as much as you all are comfortable, if you would share a little bit about, as tactically as you can, how has the pandemic actually created new opportunities to invest in these areas, and you're welcome to do both. What worries you about the surge in interest and activity? Because I think we've seen before that that fast isn't always quality, and so I'm sure for some of you that have been working on these issues for a long time, there's equal parts sort of optimism and concern, and would just love, again, as much as you're comfortable, to dig in a little bit. And since I'm putting everyone on the spot, I'm obviously going to start with Eric, because that's very on brand for me. So Eric, anything you want to add or share?
No, I love the quote, I don't know where I'm going, but I sure am making good time, right? And I think that with the emergence of ESG, everyone just says, gosh, well, that's where I should be. Let's just put money towards it. And they end up doing the equivalent of using Google Translate, right? And just saying, okay, which ones are ESG? And even when you're in the industry, it's difficult at times to understand, okay, what type of framework when it comes to ESG measurement and management is the manager actually using? And they're all so different. And so, I mean, my hesitation is pointing to such a short period of time and saying ESG is outperforming, and that's 6 months of data. And I mean, if you look at in the publicly traded space with public equities, there's such a spectrum of managers who have access to ESG data. There are managers who put ESG or sustainability in their name. And then what I think is the big differentiator is that they have ESG within the prospectus, right? The legal documents of what they're trying to accomplish. And those are the types of funds I want to make sure we look at. But a typical investor is not going to be looking at the prospectus of a mutual fund to see if ESG is embedded in there. And I think that's where we as advisors step up and help articulate what the framework is and say this is authentic and this is how they're going to measure it and manage it.
When misconceptions do come through the door, and I'm sure there's a wide variety of what those are, do you find that they are mostly about the economics or the fundamentals of the investment, or are they more about the potential for actual long-term impact, or both? Where do you find the divide or the misconception, the lack of education? Where does that usually happen?
So I think it really goes back to understanding the framework.
Right.
If you just had access to Morningstar, you might say, okay, this one has 5 hearts, right? That's the Morningstar framework. But really understanding how you get 5 hearts, who's actually giving them 5 hearts, and what do 5 hearts versus 4 hearts mean? And then you look at everything else from MSCI to Thomson Reuters. Everybody's giving you a bunch of data, but it's up to the manager to actually make sense of the data. You got to scrub it, you got to clean it, you got to put it into your own framework, and then you have to use it in a way to pick the right companies, right? And I love the quote, data just doesn't measure progress, it inspires it. And I think what we're trying to do with impact investing is take as much data as we can, and we're advocates, right? We're banging on the door saying, companies, we want you to disclose this data, right? How are you paying your employees? Equal pay for equal work, carbon intensity, right? I want to know that because it's material to me making an investment decision. So please disclose it. We're far from that. But I think if we keep saying we need more data, then I think we're going to see some really cool stuff coming from managers and how they use that data to inform investment decisions. So all getting back to the framework of using the data within the investment process.
Yeah, awesome. I couldn't agree more. So appreciate that. Catherine, what about for you, for RBC Wealth Management?
So I think what Eric said is spot on. We're really worried about these ESG light products that are coming out, seeing is it a marketing opportunity? Oh, we can offer this, we can do it. Slap on a little name on your fund and you're golden, which is exactly what clients should be very worried about, because you got to know what you own. And just because you slap a name on top of a fund doesn't mean you're going to get what you really think you're getting. So I'd be very weary of, a lot of these ETFs that are coming out that kind of have everything and may be exactly what you don't want to invest in. But I think, getting away from the ESG performance issues, which, have been well documented, a lot of press coming out about the outperformance. In terms of, general trends, I think what COVID-19 has really done, I think you already alluded to it, you saying shine a light on. This is all going to result in an acceleration of trends that were already underway. And with every crisis comes great opportunity. We know that. We see that every single time. That's, part and parcel of the capitalist system that we have, is in that innovation is rewarded. And there's going to be a ton of innovation that will be accelerated, that is going to come out of this. And we're going to look back at this 10, 20 years from now and say, wow, that was quite an acceleration. A lot of the digitalization trends, pretty much accelerated by many years. Obviously, we are on this Zoom call right now, right? That wouldn't have happened. And look at some of the technologies, telemedicine, all of this education, I think was caught in a hard space in terms of being prepared. So all of these industries, these sectors are gonna have to evolve. And that's one of the things that is, again, that's just part of natural business and what we see. But it was such a dramatic, wow, you're going to see that huge acceleration. Brick and mortar retail already, kind of on its death knell, maybe the last nail there in the coffin. We shall see, right? There's just a lot of these trends that were already underway that are just going to be, they're so painfully obvious now, and that's just going to accelerate the transition.
Catherine, I'm inspired by the idea of innovation, because I think it is, when at the individual or family level, this is such a tough time, it is appropriately difficult to sort of look beyond that and think, is this an opportunity to change the systems that are broken? As you think about innovation, we hear a lot of conversation around innovation, around product structure and product delivery. And some criticism sometimes of making financial products too complicated. And then innovation in terms of investment opportunity. So to your very excellent point about how the education space has changed, is virtual delivery actually better for learning outcomes? As you're thinking about innovation, is there one or another type that is more inspiring to you, or do you feel like we're going to need both? How do you think about that?
I think it's going to come across many industries. I mean, it's been very obvious in terms of the healthcare system and some of that, certainly how we think about traditional consumer items. But, again, this is a very broad-based transition that we're going to go through. And I think the call to arms of, hey, don't, the impact industry, don't let this opportunity, come by and let it go. Climate change, we need to be able to integrate all of these issues alongside, right? This is not like, okay, climate change, just sit there on the sidelines while we figure out COVID. No, this is all together, exactly what Justina was saying, integration. We have to be very focused and be very strategic in using this opportunity of crisis to really advance the broader goals, because we can't lose sight of the bigger issues, even though we're so preoccupied with kind of like the daily shelter in place concerns.
Totally. No, I couldn't agree with that more. Thank you. Justina, what about for you? Surprises?
Yeah, I just wanted to, on this innovation point, I fully agree. And I think, the call to action that Catherine just issued is really important, because I think, like anything else, technology and innovation has a lot of positive benefits, and potentially some, hopefully unintended, but potentially some negative consequences. And I think, we as an industry have a responsibility to ensure that, not to impede progress at all, but, as Catherine mentioned, to support innovation and the development of new technologies in a variety of sectors, but to also ensure that we're thoughtful about not perpetuating this systemic issues that got us here in the first place, and that we're thinking about equity and access and justice in the way in which these innovations, whether it be in products and services or in processes, are deployed. So I think that's just one thing to bear in mind as we're looking towards the future of work, the future of education, the future of mobility, everything.
No, I love that. We just had a question come through. I'm so glad someone asked it so that I don't have to be the bad guy. And we'll resort to anarchy. So whoever wants to answer it, all the rules are gone. Whoever wants to answer it, please feel free. But all three of you alluded in some way to impact washing. And Catherine, I think you very articulately sort of suggested that now is probably the worst time for it. And it's certainly something that we've heard, that in the rush to look at ESG as a more compelling solution to very systemic problems, that we have sort of a lack of impact integrity, which then, as we joke all the time with our clients, brings down the class average, which nobody wants. Nobody really wants to be graded on a curve. So anyone who wants to jump in and talk about why, in fact, now is the worst time for impact washing. Because I think it's an interesting idea that we need impact the most, but we need to be most careful. It's a little bit of a hurry up and wait.
I just have to comment that I've always leaned on having a curve to get my grades up as a child. But I totally agree with you on this point. And I think, you know, what I think is pleasantly surprising to me is I've always been in the conversations around impact washing, and they change throughout the years, whether it's institutional money is now coming in to the game, or, you know, you're now seeing more funds. How do you maintain the authenticity of it? And I think at the same time, the impact ecosystem has grown as well, to the extent that you have so many clearinghouses, if you will, that are going to hold these players accountable, right? And so when you had the TPGs and the KKRs coming out with their funds, you had the intermediaries, you know, like Spectrum, like Tideline, like Align, Weatherby, RBC, to speak with the client, help understand, again, that impact framework, the intent. Is it authentic? Are they going to measure it? Are they going to management? Okay, does this work for you? And then let's move forward. And you have that conversation on such a personal basis, right? Because some people are going to say yes and others no, right? Depending on their definition of impact. So I guess I'd only respond to that by saying, as this space grows and as we keep an eye on greenwashing, I find some solace in that our space is growing so much that we do have those intermediaries that you can lean on to hold the institutions, the funds, and those managers accountable for the impact that they're looking to create.
Yeah, I would just add that I think, the placement of capital is not, our job doesn't begin and end there. There's due diligence obviously up front that needs to be done in order to ensure that there's that integrity. But also, on the back end, portfolio management, both from a financial and impact standpoint. And if you're doing your job right, the better the impact, the better financial outcomes as well. But that sort of portfolio management on the back end is incredibly important for accountability. And I think, I think both Catherine and Eric do this as well. And everybody I know within the impact investing space asks these questions of every single one of their managers, as well as every single potential manager they're talking to. And I think that the signal of those questions is really important, and the discernment that those questions help us discern sort of the quality of impact and the real the legitimacy of the impact that's being created. And I think we all have a responsibility to steward our assets appropriately, and sort of in the public equity space and at that level, I think it's not just within public equities, but in general, there is a responsibility to engage. But Catherine's colleague, Tom Van Dyke, is a pioneer within the space of shareholder engagement and shareholder resolutions. And so that's yet another way to sort of ensure that, it's first, there's accountability, but secondly, that there's a collective desire and a collective goal of improving over time.
So I would just add that, in terms of why it's so important now to really know what you own. And, yesterday we're looking at a so-called ESG, fund that had, focus on environment, when we're looking up and down in this and we're noticing some obvious names in the energy space that would be really suspect if they had really done their diligence. And especially with the performance issues we've seen in the sector, certainly if you look at an S&P sector, the first quarter, and you break down all the different sectors, the energy sector was down 51%, right? So not only from obviously all the huge impact and sustainability issues we're talking about, but from performance. I mean, just seeing that and clients not really realizing, oh gosh, I didn't realize I had access or exposure to this because I didn't really know what I owned because the fancy name was on top. So it's critically important right now.
I appreciate that. And I think you've all hit a very appropriate nerve because, of course, now that we have 10 minutes left, the questions are flying in. So let me preface this by saying to the folks that we don't get to, my apologies, and I'll give you all the panelists' home addresses so that you can show up and socially distance ask questions. That's probably the best way to do this. We do have another really great question around influence and leverage. So the question is sort of getting all of your insights on the best point right now to actually inspire change. If you had to choose between investors, asset holders, data providers, owners, OCIOs, grassroots activists? I mean, it's an unbelievably tough question, but from where you sit, is there a particular area where you think if we could just move the needle with this one particular audience, we really are at a moment in time where that could create a groundswell? And I in the spirit of anarchy, I will say you can only pick one thing, knowing that that's not your actual answer. We'll caveat that by knowing that the real answer is probably everybody, but if you had to pick.
Well, I do have one thing that I've been thinking about from a Department of Labor standpoint, and their push to try to remove ESG as, appropriate investments from a fiduciary standpoint, absolutely ridiculous, because as we've seen, looking at these risk factors at the end of the day can only be beneficial from an investment perspective. So I would encourage everyone to look at the, provide comments and feedback, because every few years they try to get rid of it. Every few years they get knocked back, but they're trying to do it again. So people should really understand this and really push back.
So since Catherine mentioned the government, my mind went to former President Obama, said that the most important seat of government is that of citizen. And so I'd go with the retail investor. That's where we need to see the most movement, because everything else just follows that demand, right? What the retail investor pushes for. And I mean, in Congress today, you see over 200 bills that pertain to the environment, the protection of it, or the disclosure of certain information on the effects of what we're doing as people on the environment. So I think that you're going to constantly see the retail investor push that forward, and that's where you'll see change.
Yeah, in the spirit of anarchy, I'm going to ignore your and say it's all of the above.
As you should, Justina.
But the idealist and the romantic in me agrees with Eric that it's sort of grassroots, bottom up kind of. I think, if you sort of start at the very beginning of the value chain, and I would expand it beyond just retail investors, because, investors are also just a subset of the populace. And there's a huge population that unfortunately has been left out of the incredible gains that investing in the stock market has provided to people the past 30 years. But yeah, I mean, I think, as we're seeing in this incredible Black Lives Matter movement, the individual voice really matters. It certainly matters in investing as well, because that whole value chain matters. But, individual people have a voice, and they have dollars in the way in which they choose to spend their, they vote with their dollars in terms of where they choose to spend their money, how they choose to spend their money, how they choose to engage, and who they choose to be in every facet of their lives, as employees, as consumers, as volunteers, as members of the community, and as voters, critically. So all of the above, and the grassroots romantic idealist in me would say the people.
I love that. I love that. What a perfect time to be talking about the power of the people. So I absolutely love that. Similar to again, you've all touched on this, but everyone has spoken a little bit about impact investing as an opportunity for unrealized alpha. And Justina and Catherine, you both made reference to ESG outperformance during the pandemic. Eric, you were talking a little bit about how these things all come together. Let's say that you have a client that walks in from day one, highly skeptical, dragged into your office. What are you don't have to name them specifically, but what are the resources that help you really squash off the bat this consistent myth narrative that we can't seem to crack around concessions and the fact that there is an unrealized opportunity? Do you have one or two resources in your toolkit where you just point to immediately to say, this is actually about opportunity, it's about unrealized alpha, it's about risk mitigation? How do you approach that conversation?
Well, for us, it's all about data and showing the path, right? Showing historical performance, showing how funds have performed relative to non-ESG funds. It's really important for people to see historical metrics, even though, of course, past performance can't guarantee future return. It's important for them to say, well, how has it done? Some people, if they're skeptical, they don't realize what has been happening over the last, many decades, and they just may not have had access to the information. So our job is education and providing them resources. We bring them not only the data, we'll actually give them the reports and say, hey, look, this is not our stuff. These are, could be government agencies, it could be nonprofits, it could be other financial institutions. We don't take, it's not like, we have pride of ownership of everything out there. There's a lot of players out there with a lot of great data. And just showing them, here are the resources for you to educate yourselves. Obviously we're here to educate you, but empowering them with the tools and resources so they have it in hand, so they don't feel like, oh, you're trying to convince me of something I don't really believe in.
Yeah, I agree with everything Catherine said. I would just add, first, skepticism is healthy. I think you should be skeptical. You should be skeptical about any investment. I mean, it's not because it's an impact investment or an ESG integrated investment that you should be skeptical. You should always, have a healthy amount of skepticism around anything and ask the right questions. So I think, first is acknowledging absolutely it's legitimate to ask these questions. Please do, and let me answer them and let me respond to them with, data that Catherine mentioned. But also I think it's helpful to pick a specific example of an investment thesis of how certain kinds of impact themes lend themselves to a clear investment opportunity. And I think, most people sort of recognize that within climate change. If you have a growing global population and an increasingly consumptive middle class, that leads to increased resource demands. Couple that with increasing resource scarcity driven by the fact that we're utilizing non-renewable resources or degrading our existing natural resources so they can't provide the ecosystem services that we need. It stands to reason that companies that utilize renewable resources, utilizes resources and inputs more efficiently and more sustainably, and is able to restore degraded resources so that they are able to provide the ecosystem services we need. It stands to reason that those companies are going to outperform in the long term. And that is sort of just, so it's sort of acknowledging the skepticism, providing the education and resources and the data that Catherine mentioned, and then giving a very clear example that makes logical sense to people to sort of complement the other components of the argument.
Wonderful. Awesome. I so appreciate that. We are truly coming down to the wire. So in the very artificial power that a moderator has, I am going to throw in yet another curveball and suggest we do a wrap up with a really quick lightning. No real surprises, I promise. And that is in less than 30 seconds, if you could share the one best piece of advice you have to potential clients or asset owners out there that are thinking about how to get involved in impact investing. The one, again, Sophie's choice all over the place here, but the one thing that you think every client should hear before they take the plunge.
So taking a cue from Eric in sort of quotes and phrases, one of the things that, a lot of people have heard me say, because it's literally one of my favorite things to say, which is don't make the perfect the enemy of the good. There's absolutely urgency in addressing these issues right now, but it's also a journey. Just get started, harness this energy, just get started, learn, and iterate and deepen and broaden your impact over time. And there are guides out there and resources available. And then, to Eric's point and, the sort of grassroots point, ask your financial advisor. Start asking the questions, because that is going to have a ripple effect in sort of the signaling and in sort of that up and down that whole value chain of making change happen.
So I would say, and I think I alluded to this earlier, is just know what you own. Take stock. Do an audit, figure it out. A lot of people don't actually know what they own. And I would encourage everyone to take a look. I think you'd be really surprised about what you thought you were invested in and what you really are invested in. And I totally agree with Justina's comment, just get started. It doesn't have to be all shebang. You can take it in stages. That's totally fine.
So I have to give an analogy, because I see my brother Eddie on the phone here. Which just warms my heart, because we're 2 of 5 Stevensons on the phone now. And one thing Eddie was always good at was sticking to a gym schedule since we were kids, right? So my advice would be to put together an impact investing strategy like you might a gym schedule, right? Figure out if it's a little bit often that works for you, or if it's 2 days because you want to see the results as soon as possible, right? Put in the upfront work to figure out the schedule that's good for you. If you're going to the gym alone, or you going with somebody else, right? That's an analogy for, do you need an advisor or consultant? And then the last piece is the gym you're going to, who goes there, right? Is it the right community for you? Are you talking to people that are more global, but you're focused on domestic issues? Or are you really focused on the S, but your gym has all the folks that are focused on E? So I think once you kind of plan your work and work your plan, that would be my suggestion. And shout out to Eddie on the phone here, man. I love you.
Thank you. To the folks on the phone, I'm sure you're all getting a very real sense of the fact that we've been excited for this conversation pretty much all week. And it's due in large part to our wonderful, very, very, very thoughtful, unbelievably expert panelists on this call. So thank you, Justina, Catherine, and Eric, for joining us. Thank you to everybody on the phone for dedicating an hour of your time. To folks who are joining us for episode 2, as you'll probably know, we're going to send out a link to this recording in about a week's time. And then episode 3 on impact measurement and management will be July 30th. So continue with us for this impact investing deep dive, and supreme thanks everyone here for joining us.
Thank you.
Thank you.